Good morning to everybody. Thank you for the invitation to the Austrian National Bank and the organizers. If people know me here, I doubt it, but I'm happy to be here, and I'm from the University of Luxembourg, but you can hear that I'm from Austria from my dialect, and I love being here back in Vienna for this conference. My speech will be a little different, less regulation than the last one, but also practice related and examples and ideas that are very interesting for the practice. In the next 20 minutes, we'll be thinking about the question of the role of financial markets in the transition to sustainable economies and societies and how they can help and accelerate the process. It's a difficult question to talk about in only 20 minutes, but I will try to present a few ideas in terms of economy. Before we start with that, I would like to tell you what type of role financial markets can have in a sustainable transition, what functions, what services they can provide. And the first one is, of course, the capital allocation, which refers to the last speech presentation, really, because the capital market traditional task is to find the capital and get the capital from the investors, but we will look at it differently than we just did. Not capital for projects that are maybe funded or not, but we will look at how much capital is already being invested in sustainable projects and what kind of impact it has on the companies. But the capital market also has other tasks and other roles when it comes to risk distribution and risk management. That's something we're talking about a lot in terms of sustainability. There are new types of risks, and we have to look at these risks. How big are they, and how do they affect economy, and how can the capital market or the financial market provide services in terms of risk management. Also important are financial innovations. The capital market provides new products, also in terms of sustainability, and which also meet investor needs. Talking about green bonds, but also emission markets, which are a solution for pricing the social costs of emissions. And I'm sure there are more than these 4 points, but last but not least, I would like to mention transparency and information generation. I'm a financial economist, and I'm convinced that pricing in markets or prices can provide you with information, because you have thousands of investors evaluating the information and thinking about, should I invest in this market? So this market provides a lot of information, and this is very important. And when you look into the future and try to decide what will happen in the future, market prices are always future oriented, because they analyze future activities and future events. So this information is also very future oriented. And this is very strict on the capital market. In 20 minutes, of course, we won't be able to look at all these points, but I want to highlight 2 ideas for the capital allocation on one side, and also a result of one of our studies on risk distribution and risk management. One question that is also important is, how does sustainability link with financial markets? Because financial markets are important for the transition, but where does this combination come from? And you can here think about in terms of the demand, that investors have a preference for sustainable investments. Here you have we have many investors at this conference, and you have preferences, and you have the power to steer your investments in the right direction. You can invest in sustainable products, but on the other side, there's also the supply part, and that could be that sustainability in the future could have more better return, or that it has less risk, that it makes sense to invest in sustainable products because it is better in terms of risks for your investment. So that would be an argument that investing products that are sustainable are more attractive to investors. And of course, what is important is the regulation for demand. We tried to make this speech a little softer, so we would like to ask a question to the audience. Which of these aspects do you think is the biggest driver for capital flows in sustainable investments? It's a question you see here, or you can access here. Which of these arguments, investor preferences, regulation, or expectations of risk and returns, what do you think is the most important? I think we have our answers. We can start discussing it. That investor preferences has the lowest support, regulation the most, and risk and return expectations are in the middle. I expected this result, and I'm a little sad about that, because investor preferences will be important in the future in order to carry out this transition, because if the investors are interested in investing in sustainable products, we can carry out this transition successfully. On the other side, it's no surprise, because we have heard it today and yesterday that at the moment regulation is dominating the discussion. So it's not a surprising result, even though I was hoping that the investor preferences would get more answers. Let's go back to the presentation. Of course, you're right. In the last 12 or 13 minutes, I would like to present a few examples. On one side, we have capital allocation. We have one study here, the Luxembourg Sustainable Finance Initiative, an overview of the Luxembourg fund market. It's the second biggest fund market in the world. And you see how much capital in a fund market is invested due to sustainable criteria. So you see 2022, 2023, and 2024. You can see all funds in Luxembourg, where we have trillions of euros. More than 70% are invested due to in relation to sustainable criteria. So here you can see big numbers in this sector of the capital market is being invested in sustainability. So on the right side you can see the different strategies. Yeah, and you can say a big part is of these sustainable investors would rather invest in sustainable products than in, for example, companies who use fossil fuels or arm companies and so on. So if we have so much capital to be invested in sustainable products, how can this capital allocation have an impact on the real economy? If I, as a sustainable investor, take away my capital from brown companies and give it to green companies, how can that be an incentive to companies to go from brown to green? And here we have the capital cost mechanism. So the reallocation of capital. So the capital costs of brown companies is increased. If they want to carry out more brown projects, they have to pay more. They have more capital costs. And at the end, it means that for them, it is better to switch to green products and green project. The question is this an incentive for the companies? And that at the moment is a very important question, and where we don't have any consensus yet on no final result. There are different opinions. We have a study from Berg and van Binsbergen who are saying that even if the capital allocation only slightly increases the cost of capital for brown companies, and it does not have the strongest influence on the transition. So just because of this capital allocation from brown companies to green companies, and they show it empirically as well, that the capital costs for these companies are not very high and not really an incentive. But we also wanted to look at this and find maybe a different result. And we looked at the studies and analyzed their study, and we showed that it also depends on how easily the transition from brown to green projects is for companies, and that even small capital changes in capital costs can have an impact. So our analysis that we just published showed that even small increases in the cost of capital can provide incentives for brown companies. Another point I would like to mention is the risk assessment, risk management, because here capital markets always play an important role. Deputy Governor already talked about the NGFS, and here we have 3 scenarios from the NGFS in order to show the future in terms of the impact of risks related to the transition to economy figures. So I would just like to show how strong and how important these risks in the macroeconomic scenarios are. You see the pillars on the right side, which is the negative scenario, the current policies, where we don't move, where we don't transform. And then you see 2030, 2040, and 2050, the years. This is just a simulation. So it is a simulation of the GDP decreasing because of natural disasters. For example, droughts, winds, strong winds, and so on. And the green ones would be the rising of the sea level, the ozone layer. And if you look at this, you can see the simulated costs of those physical risks are very big, macroeconomically very big and significant. So now we have to think about, if you come from the capital market, does the capital market think the same way as they are simulated in these graphics? are these risks part of the capital market? Do the investors know? And are the prices of companies in accordance with these risks? So I would like to know if today, if you buy a global portfolio of 500 equity shares, do you think the prices of these shares can be impacted by climate risks and nature risks? I think it's a question of if you're at the moment empirically impacted at the moment, not if you think you should be influenced, but if you are. If the price of a company exposed to, for example, strong winds is different to the price of a company that is not exposed to hurricanes or other strong winds, for example. Like, what do you think? So a lot more people have an opinion to this question than to the first question, which is very interesting. So almost 60% think that yes, they are influenced, and 40% think that not. If I try to answer this empirically, I have to firstly say that there are not a lot of studies on this and this type of effect. What many studies have done is that they didn't concentrate on the physical risk, but the risks of transition, so more regulatory risks and risk in terms of technology, for example, stranded assets, that some technologies are just not relevant anymore. So a lot of studies focused on these types of risks. And they found out that these transition risks for companies do influence the price. But the literature does not have any consensus if the prices went up or down. So there's still discussion on which direction this is moving, but we concentrated on the physical risks, so the extreme weather conditions. And this was the answer to this was always that this is not part of the prices. This does not influence the price, and the capital market does not reflect these types of risks. And so we tried to analyze this, and we found out that at the moment these type of risks are already reflected in the capital market in a scope of 2.5 to 3% per year. So prices of exposed companies are lower than those that are not exposed. So the idea is that at the one side you have the NGFS scenario from the models, saying these risks are macroeconomically relevant, and on the other hand we show the risks, how the risks are part of the capital market. And here we have the example of the capital market helping us to quantify the size of these risks, and now we have an empirical measure for the economic effect of these risks and how they influence prices on the market. We try this in a way to find a way of we analyze news and newspaper articles talking about companies being exposed to these risks. We try to find out who are the exposed companies, and then try to generalize it to the companies who are partly exposed, and then we try to calculate it with the universe of the capital market. So if we're looking at the investor side, if I buy shares of a company that is very exposed then I would like to have some type of compensation that I'm actually investing in this type of company, that the companies that are not exposed, I do not want to invest in. So here we can see that ever since from 2002, this has been happening. So if I invested 100 euros 2002, that at the end of 2024, I would have a return of $200. Euros, sorry. Of course, there's always an up and down, for example, the COVID-19 crisis or inflation. But we can see that over a long time, it will go up. So if we look at newspapers and we can see that there is a connection of companies being exposed to climate risks are being regarded more risky by the market, and they have higher returns. As a conclusion, I wanted to show you that the capital market, on the one side in capital allocation, is very active in this term. But does this really have real economic consequences? On the other side, that the capital market is more than just capital allocation. When it comes to this physical risk, there is a quantification. But these types of strategies can also be used to ensure this risk and have them in my portfolio. Thank you so much.